Very good morning to all of you. Uh, we are going to discuss about paper 15, that is direct tax laws and international taxation. But before we begin, let me just give a brief introduction about myself. And I am C. Muthu Palniyappan. I'm a fellow chartered accountant with work experience of over a decade. I had earlier worked in a big four and then started my own practice. For the last 7 years, I'm into practice. But I'm always passionate about teaching and training students. So I've been taking classes in several forums. And apart from being a faculty, I also present various technical topics in renowned institutions such as ICSI, that is the company secretary, the SARC chapter of ICSI, and then CA study circle. Apart from these two, in some of the universities and institutions such as MOP Vaishnav College and Siv Nadar University. So this is a brief introduction about me. So what we will do with this brief introductions, we'll get into a small topic for the day. When I say small topic, it's something very basic. I'm sure a part of it would have already been discussed in your intermediate itself. But before you get into the final syllabus, it's important that we strengthen the basics again. So we'll start with the basic with a small additional inputs from what you have not covered earlier in the intermediate. So when we talk about the basics, the first thing is about the residential status, right? So we are going to talk about the first module, which speaks about the residential status of an individual, particularly non-resident. So final is more, concentrates more on non-resident rather than the resident individual. But to understand who will be called as a resident, who will be called as a non-resident, we need to know the basic provisions. So when you say individual, individual might be a resident, a non-resident. And when you say resident, they might also be a resident, ordinary resident, or not ordinary resident. Last couple of years, there is also another category called as deemed resident. Whereas this deemed residents will always be a not ordinary resident. So this is for individual. So when you say resident, ordinary resident, resident, not ordinary resident, of course, let's refresh. When do you call someone as a ordinary resident and when do you call someone as a not ordinary resident? So to be a resident, there are certain conditions. It's called as a basic conditions. So there are two basic conditions. If at least one is satisfied by that individual, by the taxpayer, then he'll be called as a resident. If he is satisfying none of the basic conditions, then he'll be called as a non-resident. So the first step is to bifurcate whether he is a resident or a non-resident based on the basic condition. So what are those basic conditions? The first of the basic condition, that is first limb of the basic condition, is very straightforward, 182 days or more in the previous year. So what is previous year? If you're talking about financial year 2022-23, then from 1st April 2022 to 31st March 23 will be the previous year. So that is the first condition. The second condition is 365 days or more. 365 days or more in the 4 EP. So EP stands for immediately preceding previous year. That is last 4 previous year. So when you say last 4 previous year, it is nothing but 21-22 till 18-19. So these are the 4 years that we are talking about. And if you actually look at this limb, there is an and condition. There is an and condition. So there are two basic conditions. In the second limb of basic condition, there are two sub conditions. Both must be satisfied. So that's why we are referring to this word and. So this 365 days or more in the 4 immediately preceding previous year and 60 days or more in the previous year. So that is for the relevant year, that is 1st April 2022 to 23, he must have stayed at least 60 days here in India. Apart from that, for the last 4 years, from 1st April 18 to 31st March 2022, he must have at least stayed 365 days. So if he is satisfying this condition, then also he will be called as a resident. So that's why there are two basic conditions. He must at least satisfy one, at least satisfy one. That's why this is or condition. So at least satisfy one to be called as a resident. And when we speak about these days calculation, there are certain things that we need to keep in mind. So basically India includes territorial waters. So the entire waterfront is also India. And when you say stay in India, that is 182 days or 60 days, doesn't mean that I come today, continuously stay for 182 days or 60 days or whatever. It doesn't mean that. So it need not be continuous stay. And when you say days, It includes the date of departure and date of arrival. Very simple reason. On that day, even for 1 minute, you have been in India. Even if your flight is at 11:59 p.m. in the night, 59 p.m. in the night, you have stayed here in India for 2 minutes or 1 minute, right? So then that is also considered as a day because you were in India on that particular day. So that's why both the date of departure and the date of arrival needs to be considered as the days being in India. And last thing is citizenship or the birthplace is immaterial. You can't say that I was not born in India, so I cannot be a resident in India. These are two different concepts. Concepts like getting Aadhaar card or being a citizen of India, having an Indian passport, everything else is different. What we are discussing here is residential status as far as Income Tax Act. We are not talking about anything else. So the citizenship or being born in a particular country is immaterial. So it doesn't matter. So as long as you have satisfied one of these basic conditions, you will be called as a resident. Whenever we talk about income tax, there are always exceptions to it. So when we said two basic conditions, we said 182 days or more in the first limb, and then we said 60 days or more in the previous year and 365 days or more in the 4 immediately preceding previous year. What we must look into is this: there are some exceptions to this rule. So whatever we saw in the previous slide, we will call it as general. We will call it as general. Okay, so the general conditions. What are the exceptions? There are some exceptions. The first one is exclusively for, please remember, for an Indian citizen alone. Indian citizen. Here the word citizen comes into picture, which means he's born or brought up in, he's born in India. So he's an Indian citizen. He's leaving India. He's leaving India for what? As a crew member of an Indian ship, a crew member of an Indian ship, or for employment. You might be having so many known persons who are leaving India for employment, like they're working in Infosys, they're deputed in US or UK. They are there for a few months, few years. So typically someone leaving for employment, for them, the second basic condition, the second limb, that is 60 days or more and 365 days or more, is not applicable. To be called as a resident, for sure, they must have stayed 182 days. So it's like only one basic condition. They must have stayed in India in that previous year for 182 days or more. So that's the first exception for a crew member of an Indian ship and persons leaving India for employment, Indian citizen. And the second exception is again an Indian citizen, but here there is another concept called person of Indian origin. Just hold on for a moment. We will discuss this person of Indian origin in the next slide. As of now, let's understand an Indian citizen or person of Indian origin is visiting India, and is Indian income, is less than or equal to 15 lakhs, For him also, the only condition is 182 days or more. His income is less than or equal to 15 lakhs. But if his income is more than 15 lakhs, if Indian income. So now you all will have a doubt, what is Indian income? That also we will discuss in the next slide. So we are going to discuss two terms in the next slide. One is person of Indian origin, and another is what is Indian income. So as of now, just remember the terms alone. Do not get into it. Just remember the term before we understand it in the subsequent slide. So for an Indian citizen or a person of Indian origin who's visiting India, whose Indian income is more than 15 lakhs, the second condition, the second basic condition, which has two sub-conditions, if you actually look at it, the word 60 is replaced with 120. So now the rule is 182 days or more in the previous year, or 365 days or more in the 4 immediately preceding previous year, and 120 days or more in the previous year. So instead of 60 days, it's 120 days. So in some exceptions, it is only one, that is 182 days alone. In some exception, you have a word called 120 days instead of 60 days. So that's what it is about. So apart from all this, we understood a new concept called deemed to be resident. We said it is applicable over the last couple of years. So when it comes to deemed to be resident, a person who is a citizen of India having an Indian income more than 15 lakhs will be called deemed to be resident. But what is to be understood here? Is he will not be liable to tax for on any other country, which means he will be called as a deemed resident only if this income is not taxed elsewhere. What do you mean by that? So let's for example, let's understand he lives in a country where nothing is taxed. He is a resident of that country. Let's say country A. In country A, his entire income is exempt. He is not taxed in the country itself. It's a tax heaven. So there is no tax there. So he is not paying any tax there and he is living there. And his Indian income is more than 15 lakhs. Now, according to our laws, he is not a resident here. He is a non-resident here. So which means this income, this Indian income, if it's earned outside India, it may not be taxed here in India. So there is a possibility that it's completely escaping tax. So what they said is, if you are deemed to be resident and if your Indian income is more than 15 lakhs, you will be treated as a not ordinary resident here in India for that particular year. So that is why we call deemed to be resident. So who will be called as a deemed to be resident? Only if it is an Indian citizen who is having an Indian income more than 15 lakhs and such income is not taxed in any other country. Only then he'll be called as a deemed to be resident. So that's about the exceptions. Now we said we'll understand couple of terms, right? We said we'll understand person of Indian origin and Indian income. So what exactly is person of Indian origin? Either the self, that is the assessee, or assessee's parents or assessee's grandparents were born in undivided India. So what do you mean by undivided India? Let's assume it's before partition, before partition. So during that time, if let's say the grandparents are born and then the parents are born and then the self, either of them born in this undivided India will be called as a person of Indian origin. So that's what it refers. Why is this relevant? Because in the exception we saw citizen of India or person of Indian origin having an Indian income lesser than or equal to 15 lakhs or more than 15 lakhs, right? So we understood what is person of Indian origin. Now what should we understand? We should also understand what is Indian income. So when you say Indian income, we will understand what should be included, what should be excluded. So we are going to understand what should be included and what must be excluded. So when you say inclusion, basically what is considered as an Indian income is only business income controlled or set up in India, controlled or profession set up in India. So the only such income is called as an Indian income. Rest are actually not called as an Indian income. So this is what Indian income is about. And we were also talking about there are specific exclusions. So any income which is accrued or arising outside India, which is foreign income, which is outside India. So anything which is outside India need not be included. So when you say Indian income, it only includes business income or profession controlled or set up in India. And it also does not include accrual or arisal. When you say accrual or arisal, it also includes deemed to accrue or arise. So Section 9 discusses about when will an income be deemed to accrue or arise in India. So based on that, they're saying whatever is considered is only should be the business income, and it should exclude this what is accruing outside India and that is not deemed to accrue or arise in India. So whatever is not deemed to accrue or arise in India, that is which is not falling under Section 9, should not be included. So that's what Indian income is about. So to simply understand, whatever is earned in India and such earning is only from business or profession. So that's what it is about. So now we have understood the basic conditions. We have also understood the exceptions on how it must be. When does the days change? When that second limb is not applicable? When is the second limb becoming 120 days instead of 60 days? All this is for individual to understand when will he be called as a resident or non-resident. After that, once you have decided whether the particular person is a resident or non-resident, being an individual, it is important to understand when will he be called as a ordinary resident or not ordinary resident. So Section 6, Clause 6 provides additional conditions to determine whether a person will be called as an ordinary resident or not ordinary resident. ROR, R1, OR. So you fondly call it as what? ROR or R and OR, right? So that's what you fondly call ordinary resident and not ordinary resident. So the first additional condition. So these additional condition, if you actually see, it is OR. So if he satisfy at least one of these conditions, he will be called as R and OR. So even if he's satisfying one conditions among this, he'll be called as a not ordinary resident. So what are these? He is a non-resident in 9 out of 10 immediately preceding previous year, EP. So 9 out of 10 EP, he is a non-resident. He is a non-resident. So only the basic condition test, whether he's a resident or non-resident. So for 9 out of 10 years, he has not satisfied any of the basic conditions. So then he will be called as a not ordinary resident. So in the last 10 years, in at least in 9 years, he is not a resident. So when you say 10 years, for the if you're talking about previous year 20 to 23, the 10-year period will be 1st April 2012 to 31st March 2022. The second additional condition is he is in India. He was in India for less than 730 days, less than 730 days in 7 EP, right? So there we saw 4 EP and then 10 EP, and now we are seeing 7 EP. So 7 EP. So what period it is for financial year 22-23? The 7 previous year will be from 1st April 2015 to 31st March 2022. So how many days? 730 days, less than 730 days. So it is up to 729 days. So that's what it is about. So this is the second additional condition. The third and fourth additional conditions were recently introduced, like as I told you, couple of years. So basically, if it is an Indian income more than 15 lakhs, 120 days to 181 days in previous year. So he has stayed more than 120 days, but less than 181 days. So if that is the case, and such income is not liable to tax in any other country, we said that for a deemed to be resident, the Indian income should not be taxed in any other country. So if he's staying between 120 to 181 days, and his income is not taxed elsewhere, then what happens? He will be called as a not ordinary resident. So that's what it is about. So between 120 days and 181 days. The exception we saw was for persons who has an Indian income, Indian citizen or a person of Indian origin having more than 15 lakhs of Indian income. We said the second basic condition will be 365 days or more in the 4 EP and 120 days, at least 120 days in the previous year. So that's what we said. But here we are saying in the additional condition between 120 and 181 days, between 120 and 181 days, if he is staying, he will be called as a deemed to be resident. Thereby, he will be called as a not ordinary resident. So that's what it is. So this deemed to be resident and a person falling under this will be called as a not ordinary resident and can never be an ordinary resident. We said this is only restricted to the business income. What is called as Indian income? It is business income, which is being controlled by from India or a profession set up in India. So that's what we are calling it as a deemed to be resident. So this is what about your individual is about. So we have understood what are the basic conditions, what are the additional conditions, when do you call someone a resident, non-resident, and in resident, when do you call someone ROR or RNOR? So that is what your residential status for an individual is about. What about others? What about others? So you have HUF, you have persons, right? So we must also understand what is it called, how is it determined for others? So basically, when it comes to others, it is only resident or non-resident. But for HUF alone, it is only resident or non-resident. But depending upon the Karta's residential status, So the Karta residential status, we need to go through the basic condition. We need to go through the additional condition and see whether he is ROR or RNOR. So based on that, an HUF could also be ROR or RNOR. But in HUF, there is no deemed to be resident concept. So for HUF, there is no deemed to be resident. It is only ROR or RNOR. So that's what it is about. So now for other than this HUF, for everyone, it is completely straightforward, resident or non-resident. But how do you determine? For individuals, we said number of days. But for other than individuals, it is about the control. It is about the management control. So basically, if it is managed in India, wholly or partly. If at least some portion of that business or activity is managed from India, then they will be treated as a resident. So for a partnership firm, let's say there are 3 partners, where 2 partners sit in India and manage the business, then they will be treated as a resident, because the partners who control the business are resident in India. So that's why we are calling it as management is wholly or partly in India. Management is wholly or partly in India. And for everyone else, that is where it is not happening in India, they'll be called as a non-resident. So this is what is applicable for firm, AOP, local authority, and artificial juridical person. If you look at this, we have covered all person but for one, right? We have covered all person but for one. What it is? It's a very straightforward thing, right? What was left out here? We have discussed individual, HUF, partnership, AOP, everything, right? So what is left out? It's very simple. We have left out company. Why? Because what we are going to see here in company is a detailed understanding of how will a company be decided whether they are resident or non-resident. So determining a company residential status is something new exposed to your final syllabus. So when you say company, let's take a company could be an Indian company or any other company. So what do you mean by Indian company? When you say Indian company, we can say they are registered under Companies Act 1956 or 2013. So whichever act, old companies would have got registered under 1956. Current companies would be getting registered under Companies Act 2013. So basically an Indian company is a company which is being registered here. So the base is in India. So that's why you call it as an Indian company. So that Indian company can only be a resident, can never be a non-resident. So there is no other status for them. They're compulsorily called as a resident. So there is no concept of non-resident for an Indian company. Now, what about other companies? That is, let's say a foreign company having a branch here, or they don't even have a branch here. They are a foreign company. So what happens to them? So how do you determine foreign companies' residential status? Now the question comes, why should I determine the residential status of a foreign company? Why does it matter? They are going to earn income outside India and they're going to pay taxes or whatever policy that particular country has. And how does it matter on whether I'm a resident or non-resident in India? The point is that foreign company might be earning an income in India also, might be having an income in India also, or you never know, that company might be just situated outside India just to save tax, because of the tax policies in that particular country is so favorable. So they have set up there, but everything that is controlled or that is being managed is happening from India. So if you remember, for every other, that is for firm, LLP, AOP, for everyone we said, if a business is managed and controlled in India, then it becomes a resident. So for company, it becomes very difficult, right? Because it's not a very simple structure like your firm. There are 4 partners, 2 sits in India, 2 sits outside India. It's not that straightforward, right? Because when you say a company, there are shareholders, there are board of directors, there are some other key resources for a particular organization. So how do you determine for them? So this is where the concept of poem comes into picture. Nice word, right? Poem. From our whole very young age of schooling and other things, we get used to this concept of poem, right? That's how we train ourselves in oral communication. So how you started communicating is by your teacher training you, by making you sing various poems and lullabies and other things, right? Rhymes and other things. So poem is a sweet word, right? We all would have got used to it in our earlier schooling. So this poem is what is going to determine the residential status of a company. So what exactly is poem? So that's the obvious question that all of us will have right now. So poem is basically an acronym for place of effective management. Place of effective management. So what do you mean by place of effective management? Shall we break it down? So it's a place, right? So the place where effective management. So what do you mean by effective management? So which means where does the key persons of the organization sit? Where is this business operated from? Where is this business controlled from? So I'm going to identify that. So for partnership, we said it's straightforward. Take the see whether it is managed or controlled. Look at the partners, where do the partner reside and all, right? But for company, it's difficult because company is not all about the directors or the key persons. It is a collective decision-making organization. It's a more organized structure of business making. So now how do you actually decide where is this place of effective management? So if you actually look at this place of effective management, it becomes very critical because, as we said, this is where the business is controlled from. So to determine this, the Indian lawmakers, that is the income tax department, have given various provisions relating to active business outside India, So the company is engaged in active business outside India. So what do you mean by it? When you say active business, this active business is your regular business operations. So where is this regular business operations operated from? So is it from India? So now the question comes, how do I actually determine this active business outside India? How do I actually decide whether a company has actively operated business outside India or they have operated in India? So for that, they have given some what you call rules. They have given some conditions which needs to be satisfied to prove that the active business has happened outside India, right? So to prove that the active business has happened outside India, why is it necessary to prove? Only then they'll be called as, if your active business is outside India, which means you are a non-resident. If your active business is in India, your poem is in India. So determining the poem is based on determining where is your active business located. Is it in India or is it outside India? So what are the conditions for this? So the first condition is passive income is not more than 50% of its total income. So now the question comes, what is passive income? What is passive income? It is basically the aggregate of, that is nothing but the total of income from the transactions where both, please remember the word both purchase and sale is from or to its associated enterprises. So for time being, what we will understand is associated enterprises is something like related party. So a related party is what you called as an associated enterprise. So typically a group structure where you have holding company and subsidiary company. Sorry. So where you have holding company, where you have subsidiary company. So this becomes a group entity. So this is what you're actually calling it as purchase and sale from the transactions. Both, that is, you have purchased from a group entity, you are also selling it to the group entity. I'm sorry. So both purchase and sale is from the associated enterprises. Now, the second thing, that is income by way of royalty, dividend, capital gain, interest or rental income. So all these income, that is your income by way of royalty, dividend, capital gain, interest or rental income. If these income is there, this is also called as passive income. So the total of this passive income, if it is not more than, if it is less than 50%, it is not more than 50% of its total income. That is the first condition. And the second condition, please remember, it is all and. So all the conditions we're talking as and condition, which means all the conditions must be satisfied to be called as active business outside India. So that's why we are saying all conditions must be satisfied. It's and condition. So this entire clause is about and condition. So the first is passive income. We understood what is passive income. The next thing that we need to understand is less than 50% of total assets is situated in India. So the total assets value. So what do you call as assets value? When it comes to your fixed depreciable assets, it's the WDV. For every other assets, whatever is your book value will be called as the asset value. So this total assets value is less than 50% is situated in India. So you take the total assets, what is India, what is outside India. You see what is the proportion being in India. So if it is less than, it must be less than 50%. And the third condition is less than 50% of the total number of employees. So if there are 100 employees, count how many are there in India, If it is 30, it is 30%. So that must be less than 50%. Only then this condition is satisfied. So less than 50% of the total number of employees are situated in India or are resident in India. So this is what you're actually calling it as a employee strength, that is total number of employees. So this is the third condition. And the fourth condition is payroll expenses. Payroll expenses incurred on such employees is less than 50%. There is already a condition on employee. So why do you probably think there must be another condition on payroll? It's basically because, see, if you see, sometimes the key persons will be sitting in India. Let's say the CFO, the CEO will be here in India, but the employees will be sitting outside India. So if you actually look at the pay, the total pay, the number of employee might be less than 50% in India. But if you actually take the amount being paid, predominantly it would have been paid to persons in India, because this is where the CFO, CEO and the key persons sit, right? So this is why they have also set another condition on the pay scale, not only the number of employees, they're also looking into consideration like payroll expenses, which is less than 50% of its total payroll expenditure, the total payroll expenditure. So if you have paid, let's say 10 lakh rupees, how much have you paid? How much have you paid to the employees sitting in India? So that's what it is about the thing. So if a particular company satisfy all these four conditions, only then they'll be called as an active business outside India. So what happens if someone is an active business outside India? So if the active business is outside India, you look into the board meetings. You see where does the board meetings predominantly happen? Does it happen in India or does it happen outside India? So depending upon that, you determine their residential status. So if it's happening outside India, they become non-resident. If it is happening in India, they'll be called as a resident. So you see where is the majority of the board meetings happen. If active business is not outside India, that is, if they have not satisfied any of the conditions, then still we must look into whether where are the key management decision made, that is important decisions, not regular decisions like making your GST payments, making your TDS payments, not that. Key management decisions, whether to proceed with a particular project or not. So key decisions, where is this decision made? Where is the person making this decision sitting? Is the person in India or outside India? So you look into the place and the person and see the location. Is it in India or outside India? So depending upon that, you decide. So this is how you determine active business outside India. So what happens if the active business is outside India? You determine based on the majority of the board meetings where is happening. And if the active business is in India, then you still look into where are the key management decisions made. If that is also made in India, then they'll be called as a resident. So that's what POEM is all about. How complicated is this, right? So you have conditions, 4 conditions, and condition. Not just that, you have to also look into the board meeting, the person attending the board meeting, where are the decisions made? All this must be considered. So considering all these things, what happens is there was a circular which said that POEM is not applicable for companies whose receipts or turnover is less than 50 crores. Receipts or turnover is less than 50 crores. So that's what you refer to, probably called as small companies. Of course, the big number 50 crores, but let's understand less than 50 crores, it is considered to be small companies. So no POEM concept. So in that case, whatever we saw for other persons, that is when is an income, where is it controlled, management, whether wholly or partly situated in India, that will be applicable rather than the POEM. So POEM needs to be looked into only for companies, turnovers or gross receipts more than 50 crores in the previous year, more than 50 crores. So till that, this concept is not applicable. The concept will be management or control. So depending upon the residential status will be discussed. So that's what it is about. So this is all about the basics, right? So how do you determine the residential status of individuals and other persons, particularly company with respect to POEM? So thank you for this wonderful session.